Hey everyone, and welcome back to another video for today. So this is the current state of the market on Thursday, a couple of hours before the market closes. This video will air either later today or early on Friday. As you can see, we're taking a little breather, not by much, okay? So let's not panic because the markets are still near all-time highs, so we should definitely not panic. Now in today's video, I do want to touch on two companies that have seen their stock go down way more than others. And yet, I do think that these are incredible companies. Now, there are reasons why the stock went down. We'll discuss it as well. If you've watched the live stream, you know that it's Mercado Libre and Booking Holdings. Now, those two companies, unfortunately, the price of one share will cost you thousands of dollars. If you have access to fractional shares, it doesn't matter. But if you do not, then yes, that is an issue. But anyways, let's talk about these two companies in this video. If you have any other, let's say, very high quality businesses that have seen their stock go down, let me know down in the comment section below. We'll try and cover as much as possible. If you enjoy this type of videos, hit all the buttons. We'd really appreciate that. And if you want to support me even further, do check out the link down in the description and in the pinned comment with the top 10 best stocks to buy now, or go to fool.com/coachinvestor. Thank you very much. So first up, let's talk about Mercado Libre again, because I recently talked about that company, but Mercado Libre is one of the key pillars in my retirement portfolio. After Meta, after Amazon, there is Mercado Libre, then there is Tesla, and then there is a little bit more of Google. I like Mercado Libre because it does give me that ecosystem type of company, and more specifically in Latin America. This is a company worth $111 billion. Over the last 3 years, the stock did go up 153%, but over the last 5 years, it has underperformed a little bit. Over the past 12 months, it's only up 7.9%, and year to date, it's up 25.2%. Now, as you can see, it's currently experiencing a 15% drawdown. Now, you might say this is a company that is, it's quite expensive, right? Forward PE 40 times, trailing PE 54 times. Well, this was a company that historically has always traded at a premium. But you are paying a premium for a lot of growth, a lot of past growth. But then again, you're not paying for that. If you're a new shareholder, you're only here because of the future growth. And if you look at top and bottom line growth CAGR expected, I mean, it's above 30%. It's about 30% for a company of this scale. Very nice margins here as well. This is the one where you could say, okay, this is the Amazon of Latin America, minus the AWS. I would agree. Funny thing is that the reason why the stock actually went down is because of Amazon, or at least it's one of the reasons. So why did it drop? Amazon threat and Argentina economy. The Amazon threat, as we talked before, is because first of all, Amazon has been in those markets since 2012, Brazil specifically. So Amazon has been trying to outcompete Mercado Libre, hasn't really worked out very well. And so when Amazon announced that, well, they're going to, of course, offer things for free, shipping for free, well, here is the response from MELI. So Mercado Libre is launching a new loyalty program in Brazil that will give users access to streaming services and benefits such as cashback, fast shipping, and exclusive coupons for subscribers, according to a statement. MELI Plus Mega Monthly Plan will combine Netflix, Disney Plus, HBO Max, and Apple TV Plus with e-commerce and digital banking. Mercado Libre executives say the company will offer free same-day shipping starting October 15 for loyalty subscribers on purchases above 19 reais in Brazil. They say Mercado Libre will have 4 more fulfillment centers in Brazil by the end of the year. They're doing this because they can. And of course, their track record speaks for itself. They've been growing like crazy for the past decades. They've gone through economic struggles in Brazil. They've gone through economic struggles in other companies. Right now, there are some question marks around the Argentinian economy as well. And so I do think that this is a company that has gone through troubled times before. They survived it. They actually came out of it as a much stronger company. And I do think that the same will happen in the future. The ecosystem, the infrastructure that they've been building out throughout the last couple of years is what makes this such an amazing company to hold in your portfolio. Now, if we look at the e-commerce company and we look at the revenue growth expectations for next year, who's number one here? Mercado Libre. Looking at Amazon, we're here, of course, Amazon is at over $500 billion in revenue, so growing 10% is still quite a lot. We have your Shopify 22%, C Limited at 22% as well. So Mercado Libre, well positioned, I would say. Then, if we look at this, Mexico's old banking empires are crumbling. Traditional players are under siege from digital banks. So the traditional banks are, for example, here, BBVA, that were launched and founded in 1932. Look at who's number two. Number two here is Mercado Pago. Look at who's number three, Nu Holdings. So again, we see Mexico, of course, a crucial market here. But look at this, Mercado Pago and also Nu Holdings are taking market share, are making their way to the top. And so when we look at this business, commerce revenue, fintech revenue, almost 50-50 here. Overall, growth has been tremendous over the last couple of years. Both of these segments have grown above 50% compounded for the last almost 6 years. Like I said, looking at the forward PE, trailing PE, the average, especially over the last couple of years, has been quite high. We are now a little bit below it. Question is to you whether or not you would like to pay the premium. Well, historically speaking, buying it when it does dip, and I'll show you on the charts, it does work out. But again, you buy companies, you don't buy candles. When we look at gross profit margin, yes, gross profit margin has fallen from the peak here 10 years ago, 74.7%. But I mean, look at revenue, what that has done throughout the years. We're still here at 51.5% gross profit margin and free cash flow margin closer to 30%. Looking at revenue, we've seen what's expected for next year, 26-27%. This year, still 36%. And then in fiscal 27, still 22% year-over-year growth. EPS still growing quite rapidly, 49% in fiscal 2026, and then 35% in fiscal 2027. Looking at the stock right now on the daily, you can see that it did go under the 200-day moving average, and it's trying to make its way back up. Very, very close, actually. If we look at what it has done historically, whenever it dropped under the 200-day moving average, we can see it took a couple of days and then it recovered, maybe sometimes a week or two, but it recovered quite rapidly. This is a company, in my opinion, that you buy on the dip. This is me, of course, I'm biased because I hold it, but this is a tremendous company, great management team, incredible track record, and in my opinion, an incredible future ahead. Moving on to the next company, and that's Bookings Holdings. And yes, here as well, I mean, you have to pay $5,000, almost $200 to buy just one share if you don't have access to fractional shares. Now, Bookings is a company worth $70 billion. Over the last 5 years, you can clearly see that going out of the pandemic, the stock has done extremely well, and the company as well. This thing is up 185% over the past 5 years, 210% over the past 3 years, and 21.1% over the past 12 months. And year to date, it's only up 5.5%. Now, more recently, it is experiencing a 10% drawdown since the peak that happened earlier this year. This is also a company with a very, very nice margin profile. This is a company with a forward P of 22 times and a trailing one of 36.2 times. It has been growing quite quickly, and it's expected to grow close to 10% revenue-wise for the next 2 years, what compounded, and EPS 17.1%. Now, before I continue, the question here is AI a problem for a company like Bookings? Why am I asking that? Well, because OpenAI recently announced something, and this is basically it. This is in OpenAI, in ChatGPT, right? You can talk directly to apps like Bookings, Figma, Coursera, whatever apps that OpenAI partners up with. Maybe I'll actually remove the sound here in order not to get copyright strike. But in this case, you can also talk with Spotify, although I don't know what's the use of this, but okay, fine. This is a question about the partnership, the economics of this partnership. I mean, what is Zillow getting from this? What is Bookings getting from this? Is this purely the case of not being left behind, or are they getting something from it, right? If I suddenly search in ChatGPT, ask something about booking, and I book an hotel, is ChatGPT taking something from it? Is Bookings, of course, getting the large part of this transaction? How does that work? Now, the question is about the threat, right? Because maybe at one point I don't need to go to bookings.com. Maybe I will just be talking to ChatGPT or Gemini or whatnot, and they'll do everything. And so to maybe partially answer this question, we go back to this interview right here.
Really just go to those websites on their own and be able to almost, reverse engineer what you've created without needing to have those relationships.
Yeah, I'm smiling at you a little bit because, of course, we hear this many times. And one of the great things is establishing relationships. So, for example, you happen to mention OpenAI. And, of course, we are very proud to have been one of the founding partners with them in their operator mode. And if you saw their most recent thing, the agent mode, and I don't know if you saw their introductory video that Sam Altman led off, but if you look at that, you'll see it's booking.com that's doing the hotel booking there, which is just wonderful.
It is wonderful, but I've also seen Expedia pop up there. So my question here is, again, is it Bookings and Expedia needing to be there or be left behind, or is it just a good deal for them? That's the question, and that's also why we've seen the stock pull back a little bit. Now, if we go back to an analyst conference at the start of September, they said the following thing. Bookings is strategically focused on 5 key areas: enhancing direct consumer interactions and loyalty, expanding its vertical offerings, flight, attractions, OpenTable integration, geographical growth, especially in Asia and the United States, strengthening its payments and fintech capabilities, and maintaining a disciplined financial strategy. Generative AI is a critical enabler for the company's connected trip vision, moving beyond current multi-vertical bookings, which grew 30% year over year to a low double-digit share, to a future state of personalized one-transaction itineraries with intelligent, proactive trip management. It's funny because I've been talking about this for over a year now, but not for Bookings, but for Airbnb. These websites need to turn into AI concierge, right? I have to go on Bookings and I have to start filter and sort things. No, I want to go on Bookings. I already have a Genie level, I don't know what, 2 or 3 or so. I want to go there. I want to tell them exactly. I'm traveling with 2 or 3 friends or maybe a family. I want to travel between these 2 dates. This is the place I want to go to. This is the budget. Show me what you've got, right? And then, puff, 5-10 seconds later, you have your options. And maybe a minute later, you've paid for everything. And the flights, the hotel, everything's booked. That's the ideal scenario here. But of course, the question is going to be the return on investment. If they start using these chatbots, of course, they also have to then not spend as much money on ads, because if we are now all going to use chatbots, right, that's basically the bear case for the Metas, for the Google especially. They spend less on that. They integrate more on the chatbots and all of it. But again, the question becomes, what are the economics of these partnerships? Right? What is OpenAI getting from it? And then eventually, why should OpenAI partner with the likes of a Booking or a Zillow or whatnot? Can OpenAI eventually, with all the data that they've collected, can they offer a better experience? So it's a good question. It's a good question. But what we know right now is that Bookings is a very good business. It's not growing as fast as a Mercado Libre, but it's still growing as a business, revenue and EPS. Of course, there was a period of the pandemic, but still EPS is expected to grow faster than revenue. Free cash flow is expected to grow in line with revenue. So if we look here at gross profit margin over the years has gone up, although more recently we're still around 85-86%. Free cash flow margins pretty good here as well, 36.9% over the past 12 months. So a very, very good business to own. Now, some might say, oh, but the tariff story and all of it, United States, not great. Well, luckily for them, you look at the US revenue, they are very much diversified because the majority of their revenue is coming from outside the United States. Now, as I've just said, they do want to grow in the United States. It is a lucrative market. They also want to grow in Asia. But the majority, large majority of its revenue is coming from outside the United States. Looking at the other revenue drivers, we've seen merchant revenue increase over the last couple of years, whereas agency revenue come down a little bit as merchants went up. Advertising and others hasn't really grown that much. Total gross bookings did grow over the past 3 years at a compound annual growth rate of around 18.5%, and that grew 11.12% over the last 12 months as of the last quarter. If we look at Expedia, for example, Expedia gross profit margin are a bit higher than bookings, but free cash flow margins are a bit lower than bookings. And here as well, if we look at the stock, it's also one that went under the 200-day moving average, and currently it is already recovering a little bit. Today is that green candle right now. It is recovering a little bit above that 200-day moving average. RSI was very, very close to being oversold. Now, what's funny enough is the same scenario here. Previously, it went under the 200-day moving average, spent a couple of days there, and then we've seen a quick recovery. Same thing happened here. Of course, this was the April lows where everything crashed, but didn't spend that much time under it. If we go back even further, for example, October 2023 touched the 200-day moving average, and then it went back up. Also, quick FYI here, a lot of stocks do revisit their 200-day moving average eventually. So, bookings, Mercado Libre, unfortunately, the price of one share is going to cost you an organ. It is what it is. When are they going to split? I don't know, remains to be seen. But these are two quality businesses that have seen their stock go down on, in my opinion, overreactions. I own Mercado Libre. I do not own bookings. But what do you think? Do you own both? Is it interesting? Let me know down in the comment section below. Hit all the buttons. We'll see each other in the next one. Bye-bye.